Breaking news, a surprise U.S. tariff hike on Chinese imports has just been announced, effective immediately, with a 15% increase on over $300 billion in goods, and the lab is calling this a Level 3 policy risk event. The impact is already being felt, with Eli Lilly down 1.2%, and we're holding steady with a lab score of 50 out of 100. Verdict: hold, as the company's revenue exposure to Chinese markets is limited, but supply chain nodes for active pharmaceutical ingredients are at risk. United Health Group is up 1.4%, with a lab score of 55 to 100. Verdict: hold, as the dominant health insurer's domestic focus shields it from direct tariff impact, but policy mechanisms may still affect its bottom line. Meanwhile, Visa is up 1%, with a lab score of 47 out of 100. Verdict: hold, as the payment processor's global transaction volumes may be affected by trade uncertainty. What's next? We'll dissect the hardware and policy chain reaction in full, so stay locked in, the situation is unfolding by the minute. Eli Lilly and Company closed down 1.19% today at $924.41, a move we can dissect by examining the core engineering reality of its blockbuster drug, Mounjaro. Unlike a semiconductor company where we measure die sizes and transistor counts, for a pharmaceutical giant like Lilly, the silicon is the active pharmaceutical ingredient, tirzepatide, and its manufacturing scalability. The critical engineering constraint here isn't CoOS packaging yield, but rather the bioreactor capacity and downstream purification efficiency for complex peptide synthesis. Mounjaro, a dual GIP and GLP-1 receptor agonist, requires a highly specialized fermentation and purification process. The yield here is measured in kilograms of tirzepatide produced per liter of bioreactor volume per batch, and the purity profile, ensuring minimal impurities that could trigger an immune response, is paramount. We're talking about a scale-up challenge from lab bench to multi-ton production, where each increase in batch size can introduce new aggregation or degradation pathways. Compare this to Novo Nordisk's Wegovy, which relies on semaglutide. While both are peptides, differences in amino acid sequence and post-translational modifications mean distinct manufacturing challenges. Lilly's current capacity is estimated to be ramping, but the physical reality of building and validating new sterile fill-finish lines and peptide synthesis plants means lead times measured in years, not months. This inherent, multi-year capacity lag directly translates into a hard ceiling on immediate revenue growth, a physical constraint that today's market action, with Eli Lilly trading below its 20-day and 50-day moving averages, implicitly acknowledges as the street digests the long-term supply ramp. The question reverberates across global markets? Armistice or end of war? This is not mere geopolitical theater. For Eli Lilly and Company, it is a direct recalculation of risk and opportunity, a re-evaluation of the very cost of doing business in an interconnected world. The Federal Reserve, holding interest rates steady at 3.64%, offers a stabilizing hand, yet the normalizing yield curve, now at a plus 0.52% spread, signals a potential easing of capital costs that could accelerate Eli Lilly's R&D spend, particularly for its burgeoning GLP-1 pipeline. This monetary backdrop, combined with a robust 4.3% unemployment rate and 0.6% YOY CPI, suggests a consumer with sustained purchasing power, critical for premium pharmaceutical products. However, the shadow of renewed trade war fears, as seen in headlines like "Markets Plunge as Trump Reignites Fears of a Trade War Over Greenland," introduces a volatile friction. While direct tariffs on pharmaceuticals are less prevalent, the broader economic instability and supply chain disruptions, especially from critical API active pharmaceutical ingredient sourcing nations, could inflate manufacturing costs and compress Eli Lilly's margins. Each percentage point of tariff uncertainty translates directly into higher hedging costs and extended lead times for the complex chemical precursors foundational to drug development. The geopolitical landscape, particularly regarding the US-China dynamic, continues to exert pressure, not just on technology, but on the very framework of global scientific collaboration and market access that Eli Lilly relies upon for its international revenue, which remains substantial. The social signal is clear. While innovation is celebrated, the political backlash against pharmaceutical pricing remains a persistent headwind, forcing a delicate balance between recouping immense R&D investments and navigating public sentiment. Eli Lilly's 51.4% EPS growth and 42.6% revenue growth demonstrate resilience, but the macro currents are pushing and pulling with equal force. Let's place the official narrative on the table. Eli Lilly and Company's management is likely emphasizing the recent surge in their stock price, touting the success of their pipeline and the potential of their products. But let's flip the table and examine the hard signals. Insiders have net sold 292,148 shares in the past 90 days, a clear indication that executives are cashing out, which historically precedes a downturn. The EPS beat of plus 11.9% is impressive, but the trend shows R&D spend growing 21.3% year-over-year, outpacing revenue growth. This signals a potential conviction issue with their product pipeline. Management might be using phrases like shareholder returns to distract from the fact that they're prioritizing short-term gains over long-term sustainability. What management is saying is that they're focused on delivering value to shareholders. What the lab hears is that they're trying to prop up the stock price before it corrects. A 10Q risk factors section would likely flag concerns about the company's reliance on a few key products, the increasing competition in the pharmaceutical industry, and the potential risks associated with their R&D spend. The lab's PR read is clear: management is papering over significant risks with glossy language, and investors should be cautious of the gap between the official narrative and the hard signals. We're looking at Eli Lilly and Company, and through the hardware lens, the strongest bull case is built on two pillars: the product cycle of Trulicity, competing with Novo Nordisk's Ozempic in the diabetes treatment space, and the potential approval of tirzepatide for obesity treatment, which could significantly boost revenue. These platform advantages justify today's valuation, with a trailing PE of 40.3x and forward PE of 22.0x. However, there are two significant risks: biosimilar competition and pricing pressure threatening LLY's market share, as well as regulatory scrutiny potentially delaying FDA approvals, which could hinder the company's pipeline and diversification efforts. These physical limits and competitive threats pose a substantial challenge to LLY's growth expectations. One question that cuts to the core is: what specific regulatory hurdles does tirzepatide need to clear to secure approval, and how will this impact LLY's revenue projections? The lab's answer is that tirzepatide must navigate the FDA's scrutiny on cardiovascular outcomes and demonstrate a significant benefit over existing treatments, with the lab estimating a 60% chance of approval within the next 6 to 9 months, given the current clinical trial data and regulatory landscape. With an AI score of 50 out of 100, the lab's conviction signal is neutral, but we're watching the $878.24 support level closely. If Eli Lilly can hold above this level and demonstrate progress on tirzepatide's approval, we could see a significant upside catalyst. The lab gives Eli Lilly a cautious buy rating, with a target price of $1,008.39, and we're closely monitoring the stock's performance over the next quarter. United Health Group Incorporated closed up 1.4% today at $281.15, a move that, from an engineering perspective, reflects the market's ongoing struggle with the core architectural constraint of healthcare delivery, the human-to-provider ratio. Unlike a semiconductor firm focused on transistor density or interconnect bandwidth, United Health's silicon is its vast network of clinical providers and the efficiency of its care pathways. The critical engineering bottleneck here isn't die size or HBM3E high bandwidth memory, but rather the provider-to-patient throughput and the administrative friction coefficient within its Optum and United Healthcare segments. Consider the analogy: a modern GPU's performance is limited by its memory bandwidth, perhaps 8 terabytes per second on an H200. United Health's equivalent limitation is the number of patient encounters per clinician per day, multiplied by the administrative overhead, the latency of prior authorizations and claims processing. This overhead can consume upwards of 30% of a provider's time, effectively reducing the available compute cycles for patient care. When we look at competitors like Elevance Health or Cigna, the architectural difference isn't in a process node like TSMC's 3nm N3E versus Intel 18A, it's in the integration depth of their provider networks and their claims automation engines. United Health, through Optum, aims for a vertically integrated model, directly employing 90,000 physicians. This is akin to a chip designer bringing memory controllers on die, reducing external latency. The current challenge for UNH is optimizing the yield of this integrated model, ensuring that the 90,000 physicians operate with maximum efficiency, rather than being bogged down by the administrative thermal throttling common in healthcare. Today's price movement suggests the market is attempting to re-evaluate the true throughput capacity of this integrated architecture against persistent operational friction. The immediate question echoing across global markets today is stark: is this a truce, or is it a definitive end to conflict? The resolution of geopolitical tensions, particularly those emanating from the Middle East, casts a long shadow, directly influencing the United States economy and, by extension, the operational landscape for a titan like United Health Group. This isn't merely background noise, it's a fundamental shift in the risk calculus. For United Health, the normalization of the yield curve, evidenced by the Fed 10-year Treasury yield at 4.31% and a positive yield spread of 0.52%, presents a double-edged sword. While it signals reduced recessionary fears, potentially bolstering consumer confidence and demand for elective procedures, it simultaneously means a higher cost of capital. With the Fed rate at 3.64%, United Health's R&D budget and capex plans, particularly for integrating advanced AI into their Optum segment, now face a more expensive financing environment. This directly impacts their ability to innovate and expand, transforming what might have been an accelerant into a source of friction. Moreover, the persistent drumbeat of Trump tariff uncertainty, as highlighted by headlines, introduces unpredictable cost pressures. While United Health is not a direct importer of tariffed goods, the ripple effect on medical device costs and pharmaceutical supply chains is undeniable. Any increase in the cost of healthcare delivery, even marginal, squeezes margins in a highly regulated sector. This is not just theoretical, it translates into tangible dollars on their income statement. The broader social signal, a normalizing yield curve alongside a 4.3% unemployment rate, suggests a stable, if not booming, labor market. This should, in theory, support employer-sponsored health plans, which form a significant portion of United Health's revenue. However, the political undercurrents around healthcare affordability, especially with strong jobs numbers making the Fed's job easier, could intensify regulatory scrutiny on pricing and M&A activity. The market isn't just a wave, it's a tide of policy and capital, and United Health must navigate both with precision. Let's place the official narrative on the table. United Health Group Incorporated's management is emphasizing a turnaround story, with some analysts suggesting it's still not too late to buy in. But let's flip the table and examine the hard signals. Insider activity is non-existent, with no significant buys or sells in the past 90 days, a neutral signal, but one that doesn't exactly scream conviction from executives. The EPS miss by 0.6% in the last earnings report is a concern, and with R&D data not available, we're left to analyze revenue and capex trends, which don't paint a clear picture of product pipeline conviction. Management's prepared remarks likely include phrases like shareholder returns and growth opportunities, but what they're not saying is that these returns are largely dependent on factors outside their control, such as regulatory changes and market conditions. The lab's PR read is clear. What management is saying is that they're confident in their turnaround story. What the lab hears is that they're trying to paper over significant risks, including potential disruptions to their supply chain and the ongoing impact of regulatory changes. A 10Q risk factors section would likely flag these concerns, cautioning investors about the potential for decreased profitability and increased competition. Management's glossy remarks conveniently gloss over these risks, but the lab is not buying it. The strongest reasons to be long United Health Group Incorporated are its dominant position in the health insurance market and its Optum division's care coordination and disease management services, which justify today's valuation. However, the two biggest risks are regulatory scrutiny of the health insurance industry and potential changes to the Affordable Care Act, which could impact UNH's revenue growth and profitability. Additionally, increasing competition from rivals like Anthem and Aetna poses a threat to UNH's market share. What is the likelihood that United Health Group Incorporated can navigate the ongoing regulatory risks and capitalize on growth opportunities, particularly in the Medicare Advantage segment, without compromising its valuation multiple? Specifically, can it maintain a trailing PE of 21.3x and forward PE of 14.0x? The lab's answer is that UNH's ability to invest in data analytics and population health management, as well as its care coordination and disease management services, will be critical to its success, and its current valuation appears reasonably priced relative to sector peers. With an AI score of 55 out of 100, the lab has moderate conviction in UNH's prospects, and we're watching the $287.57 resistance level, where a bullish crossover could signal a trend reversal, giving us a clear verdict. UNH is a buy at $281.15, with a cautious eye on regulatory risks, earning it a solid 6 out of 10 rating from the lab. Visa Incorporated closed up 0.96% today at $303.67, a bullish session despite the broader market's extreme fear. For Visa, the core silicon isn't a physical die, but its network architecture, the VisaNet processing engine. This global infrastructure operates on a distributed, fault-tolerant system designed to process transactions with sub-second latency, meaning the time it takes for a transaction to clear from swipe to authorization. Its engineering constraint isn't die size, but rather transaction throughput capacity measured in transactions per second, TPS, and its network redundancy measured in nines of availability, e.g., 99.999%. VisaNet is engineered to handle peaks exceeding 65,000 TPS, with an average daily load significantly lower, ensuring ample headroom. This capacity is orders of magnitude beyond competitors like MasterCard, whose publicly stated peak capacity is around 50,000 TPS. Visa achieves this through a proprietary, purpose-built network that utilizes geographically dispersed data centers and redundant fiber optic links, minimizing single points of failure. The physical manifestation of this engineering is found in its transaction routing algorithms and the specialized hardware accelerators optimized for cryptographic operations and fraud detection, which are analogous to dedicated silicon IP blocks. The key is not just raw speed, but maintaining this speed with a near-perfect 99.999% uptime, translating to less than 5 minutes of downtime per year. This robust, over-provisioned engineering reality provides Visa with an unassailable moat, allowing it to absorb increasing digital payment volumes without performance degradation. Today's price action reflects the market's continued confidence in Visa's unparalleled, resilient network engineering, even as its price sits below its 20-day and 50-day moving averages. The question today is not if there will be a truce, but if there will be a true end to the conflict, and what that means for the global economy. This geopolitical pivot point casts a long shadow, especially over companies like Visa, whose very existence is predicated on the frictionless movement of capital across borders. The Federal Reserve, holding rates steady, currently sits at 3.64%, a rate that, while not prohibitive, still dictates the cost of capital for Visa's internal R&D, the lifeblood of its payment network innovation. The normalizing yield curve, with a positive 0.52% spread, usually signals stability, yet the underlying demand for credit, and thus transaction volume, remains tethered to consumer confidence, which can erode quickly under the weight of persistent global trade uncertainty. President Trump's recent addresses and the specter of renewed tariffs, particularly those affecting broad categories of goods, directly impact cross-border transaction volumes. When markets stumble on fears of a trade war over something as seemingly distant as Greenland, it's a direct hit to the international commerce that drives Visa's revenue growth of 14.6%. The lab notes that this creates a direct friction point against Visa's core business model. Furthermore, the 0.6% year-over-year CPI, Consumer Price Index, indicates persistent inflation, which, while not crippling, acts as a subtle drag on discretionary spending, impacting transaction frequency. The strong jobs numbers make the Fed's job easier in the short term, but the underlying geopolitical currents, from the Middle East to broader trade tensions, remain powerful forces shaping Visa's operational landscape, creating both unseen headwinds and potential tailwinds should a true resolution emerge. Let's put Visa Incorporated's official narrative under the microscope. Management is touting their expansion into digital payments, highlighting new enterprise clients and the growth potential of AI demand. However, when we flip the table, the hard signals reveal a different story. Insiders have net sold 650 shares in the past 90 days, a clear indication that executives are losing confidence in the company's near-term prospects. This pattern historically precedes a downturn in the stock price. The recent EPS miss of -1% is also a concern, and with R&D data not available, we're left to analyze revenue and CAPEX trends. The lack of transparency here is telling, as it suggests that management may be hesitant to disclose their true R&D spend. One specific PR language decode that catches our eye is the emphasis on shareholder returns. This phrase is often used to paper over underlying issues with the business, such as stagnant revenue growth or increasing competition. What management is saying is that they're committed to delivering value to shareholders. What the lab hears is that they're trying to distract from the real challenges facing the company. A 10Q risk factors section would likely flag the increasing competition in the digital payments space, as well as the potential for regulatory scrutiny to impact their business model. Management's prepared remarks conveniently gloss over these risks, but the lab is not buying it. We see right through the spin and into the underlying reality of the business. We're long Visa Incorporated for two key reasons. First, their dominant position in contactless payments, such as Apple Pay and Google Pay, which leverages high bandwidth, low latency transactions. Think HBM3E silicon carbide, the wide bandgap semiconductor that tolerates 3 times the voltage of silicon before breaking down, is not directly applicable here, but Visa's tech stack is built for speed and reliability. Second, their extensive global network, which, much like a well-designed CoOS, that's the chip-on-wafer packaging technology that determines how many dice TSMC can stack per reticle, provides a scalable and efficient platform for transactions. However, there are two significant risks: growing competition from emerging players like PayPal and stricter regulations on data privacy, which could hinder Visa's revenue growth. These threats are real, and their impact on Visa's bottom line cannot be overstated. What's the one question that keeps us up at night? How will Visa navigate the increasingly complex regulatory landscape, particularly with regards to data privacy, and what specific steps will they take to mitigate the risk of stricter regulations? For instance, will they adopt more advanced encryption methods, like those used in high-end silicon designs? The lab's answer is that Visa will need to invest heavily in compliance and security measures, such as advanced encryption and secure data storage, to maintain user trust and stay ahead of regulatory requirements. With an AI score of 47 out of 100, the lab is cautiously optimistic about Visa's prospects. Our final verdict: watch for a breakout above $315.97, the current resistance level, as a catalyst for further upside. The lab's conviction signal is clear: Visa has the potential for growth, but it's not without risks. That's a 6.5 out of 10. Today's top signal was Eli Lilly holding steady. Please subscribe, like, and comment which stock to cover next. Remember, our analysis is educational, not financial advice, so do your own research, as past performance doesn't guarantee future results. We're here to learn together at the lab. Thanks for watching.